Marketing Metrics book. This chapter deals with markups and margins. The purpose of any business is to create a customer, according to Peter Drucker. We have to acknowledge the fact that a business cannot survive unless it has both a margin and a customer. As marketers, it is imperative that we know the margins for all the marketing decisions that we make. These margins represent a key factor in expressing your return on investment, calculating earnings forecasts, and analyzing the future profitability of any new products. Bearing this in mind, we have to mention that margins can be divided into two subsections: percentage margins and unit margins. A markup expresses the profit component of a product as a percentage of the cost price and is generally used in setting your selling prices. A margin expresses the profit component of a product as a percentage of the selling price and is generally used to calculate the gross profit from a turnover amount. It is important to remember, when you're talking about the percentage profit component, to specify which method you're referring to. You can either achieve a 50% markup on your products or a 30% margin on your products. A simple way to remember this would be that markup belongs to cost, whereas margin belongs to sales. For example, if you buy something for 10 Rand and you sell it for 20, the profit made was 10 Rand. In this case, the markup on your cost has been 10 Rand profit divided by 10 Rand cost, which gives you 100%. But the margin on your sales has been 10 Rand profit divided by 20 Rand sales times by 100 to get to your percentage, which will then give you 50%. We use margins to determine the value of incremental sales and to guide our pricing and promotion decisions. Margins are typically the difference between your sales price and your cost price, and it can be expressed as either a currency, which is referred to as a unit margin, or as a percentage, which is also known as a percentage margin. For example, if a company uses model boats, the unit selling price will be 50 Rand and the unit cost is 25 Rand. Your unit margin would be selling price per unit less cost price per unit, which will be 25 Rand, because 50 Rand minus 25 Rand gives you 25 Rand. Your percentage margin would be your unit margin divided by your selling price per unit. If you take 25 Rand divided by 50 Rand, you will get 50%. That is a very basic introduction to Chapter 3, and in our next video presentation we will look at margins in more detail. Money, 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 money.